Wall Street can feel like a total storm of noise and numbers, right? A place where it seems like fortunes are made and lost in the blink of an eye. But what if there was a way to build a fortress against all that chaos? Well, that's exactly the promise at the heart of Benjamin Graham's masterpiece, The Intelligent Investor. And today, we're going to unpack its most powerful, timeless ideas.
To really get a handle on this madness, let's start with maybe the most brilliant mind in human history, Sir Isaac Newton. This is the guy who figured out gravity, invented calculus. You'd think if anyone could crack the code of finance, it would be him. But oh no, his story tells us something very, very different.
So this number, $3 million, that's how much Sir Isaac Newton lost in the stock market, in today's money. The genius who could literally explain the universe got completely swept up in a speculative frenzy and was basically wiped out. How in the world does that happen?
Newton's disaster perfectly captures our first big idea, what Graham calls the madness of crowds. It's this timeless, fundamental flaw in how we all think when we're in a group, and believe me, it's a pattern that just keeps repeating itself.
Just fast forward a few hundred years to the late 1990s. It was the same story, just with a new techie twist. The internet was changing everything, and investors got it in their heads that the old rules of business value just didn't apply anymore. They started chasing any company with a .com in its name, sending prices to the moon.
And just look at the sheer scale of this. It's wild. In 1999, a whole group of popular tech stocks skyrocketed by almost 1,200%. Unbelievable, right? But what goes up that fast? Well, it tends to come down even faster. When that bubble finally burst, those same stocks just cratered, wiping out every last bit of those gains, and then a whole lot more.
And this quote, wow. This just perfectly captures the thinking at the absolute peak of the craziness. This is a real quote from an analyst in January 2000, just weeks before it all came crashing down. The argument was literally that price doesn't matter anymore. That, my friends, is the classic siren song of a speculative bubble.
So how do you protect yourself from getting swept up in this kind of madness? Well, Benjamin Graham says it all starts with one single decision you have to make before you ever put a penny in the market. You have to decide, are you going to be an investor or are you going to be a speculator?
Graham drew a very, very clear line in the sand with his definition. He said an investment is something that, after you've done serious homework, promises you two things. One, your original money will be safe, and two, you'll get a decent return. If an operation doesn't meet both of those criteria, it's not investing. Plain and simple, it's speculation.
Let's just break that down a bit. The investor, over on the left, is thinking like a business owner. They're analyzing the company. They're obsessed with not losing money, and they're aiming for a solid, adequate profit. The speculator, on the right, well, they're basically gambling. They're trying to guess which way the stock price will go, chasing what's hot, and just hoping for a quick, massive payout. It's a totally different ballgame. And this is the question Graham really wants you to ask yourself, with total honesty. Is your whole approach based on the real-world value of a business, or are you just placing bets on what the crowd is going to do next?
Okay, so once you've decided you're going to be an investor, Graham gives us this incredible mental tool to handle the market's crazy ups and downs. It's a simple but absolutely brilliant little story about a character he called Mr. Market.
Just play along with this for a second. Imagine the entire stock market, all its fear, all its greed, all its chaos was rolled up into a single person. What kind of person would that be?
So here's the story Graham tells. He says to imagine you own a piece of a great business, and you have just one partner. His name is Mr. Market.
But here's the thing about your partner. He is emotionally unstable, to put it mildly. Some days he shows up absolutely euphoric, screaming about how great things are, offering to buy your shares from you at ridiculously high prices. Then, the next day, he's in a total panic, completely depressed, and he's begging you to take his shares off his hands for pennies on the dollar. The prices he quotes have nothing to do with the business's actual value, only with his mood of the day.
So what do you do with a partner like this? Graham gives you two dead simple rules. Rule number 1, you are totally free to just ignore him. You don't have to do anything. Rule number 2, you should only ever deal with him when his crazy moods are to your advantage. So when he's panicked and selling cheap, you should think about buying. And when he's ecstatic and offering you a silly high price, maybe you think about selling. The point is, you use his moods. You never ever let his moods use you.
Now, this idea of taking advantage of Mr. Market's bad moods leads us right into the absolute cornerstone of Graham's entire philosophy. It's the one concept that gives you real protection, the secret to sleeping well at night. He called it the margin of safety.
So what does that actually mean? In the simplest terms, it just means you don't overpay. Ever. You start by figuring out what a business is actually worth, its intrinsic value. Then, you wait until Mr. Market, in one of his bad moods, offers it to you for way less than that. That gap, that discount, that's your margin of safety. It's a cushion that protects you if you're wrong or if bad luck strikes.
And there's really no better real-world example of this than when Graham's most famous student, Warren Buffett, took a look at the Washington Post Company way back in 1973.
So at the time, Mr. Market was in a really bad mood about newspapers. He was pricing the entire Washington Post at just $80 million. But Buffett, he went and did his homework. He looked at all the assets, the paper, the TV stations, and figured out they were worth, at a minimum, $400 million. He was literally being offered the chance to buy $1's worth of assets for 20 cents. That is a massive margin of safety.
All right, you might be thinking, this all sounds great in theory, but does this stuff actually work in the real world? Well, the thing is, Buffett wasn't the only one who learned these lessons. There was a whole group of investors who followed Graham's philosophy, and they went on to produce some of the best investment records in history. Here are just a few of them. Buffett famously called them the super investors of Graham and Doddsville. Now, these guys all worked on their own, they bought different stocks, they had different personalities, but they're all connected by one single powerful idea they learned from Graham.
And here it is, straight from Buffett himself. The secret sauce was surprisingly simple. In their minds, they weren't buying stocks. Those little tickers flashing on a screen, they were buying pieces of actual businesses. And their entire strategy for all of them was to find and exploit that gap, that margin of safety between the price Mr. Market was quoting and what the business was really worth.
And that really brings us to the ultimate lesson from the intelligent investor. Your success in the long run has almost nothing to do with being a genius who can predict the economy or find the next big thing. It has everything to do with building a solid intellectual framework for yourself and then having the emotional discipline to actually stick to it.
Look, the madness of crowds that got Sir Isaac Newton, that's not going anywhere. Mr. Market is always going to have his euphoric highs and his depressive lows. That's a permanent part of the game. The only thing you can actually control in this whole equation is you. So the real question is, will you let yourself be irrational too?